Government is looking to raise almost 20 billion cedis in bonds and treasury bills for the third quarter of this year. Now, a fundraising calendar released by the Finance Ministry was, however, quick to add that 15.8 billion of that amount would be rolling over existing bonds. Now, this should mean that it will be actually seeking a little over 2 billion cedis in fresh funds from investors, but with the country's debt stock at 236 million cedis at the end of March. This fundraising would obviously increase the country's total debt stock, which investors have described and analysts also have described as worrying. Well, joining me to discuss this is Courage Mate, who is an economist with Data Bank, on what this implies. So, Courage, 20 billion cedis in bonds and treasury bills for the third quarter, 2 billion cedis in fresh funds. Is this needful or just another borrowing spree?
Having me, Darrell, this is inevitable. But let's start by saying that about 89% of the total or gross issuance target is just to roll over existing debt. So the debt portfolio will not change because of the 89% component of the total issuance. However, the new borrowings will be about 2 billion cedis, which would be the addition to the debt portfolio in this particular window. But then again, if you contrast this particular calendar with the just ended calendar, you also notice that this new borrowing of about 2 billion cedis is about half of what the previous calendar targeted to do. So it means that in this new calendar, the borrowing is quite less compared to the previous calendar. Essentially, there's a signal that the government or the Treasury is sending to the market that, well, normally you have deficits that you have to fund through borrowings, right? But COVID-related issues has widened the deficits. Notwithstanding this widening of the deficits, government signal to the market is that they are intent on borrowing at a cost that would not jeopardize the debt sustainability outlook and the strategy. So you would notice that they've done non-concessional financing from the IMF and World Bank. Then over the last couple of weeks or months, we've seen interest rates on the downturn, so that if they have to do market borrowings, it will be coming at a lower interest rate compared to the historical past or the maturing debts.
I guess you can anticipate my next question to do with our ballooning debt and what this implies.
Well, yes. So for as long as the deficit widens, and that means you have to spend more than the revenue you mobilize, even worsened by the exogenous shocks of COVID-19, and government will have to fund that deficit. So we shouldn't be surprised to see a surge, a steep rise in the debt portfolio. Now, careful movement must be made, because if you look at the end of last year, the fiscal data showed that the interest payment as a ratio of our total revenue increased by 4% to 37% of our total revenue. Now, with an increase in the debt stock expected this year further up, there is a risk of interest payment consuming further parts of our revenue. And that is why we must emphasize less expensive debts, interest-free and non-concessional debts going forward, so that even though the total debt stock will go up because of COVID-related widening of the deficit, the cost structure of the debt will be firmly under grip.
So that's what you propose, less expensive debt, so that we can strike the balance amid the concerns that we are borrowing too much?
Yes, absolutely, because the debt accumulation, given the extraordinary times we find ourselves in, is inevitable, and it is happening around the world. So central banks are even funding government, and that is a debt. It's just that it's not an open market debt, right? So the debt accumulation is inevitable. How or at what cost did you accumulate this debt? This will be what investors and the market will be watching to determine your debt sustainability outlook.
And one other big economic news this week was inflation rate for the month of May hitting 11.3%. We are told that is the highest in the last 10 months. And just as we were being hopeful that the rate would improve as lockdown restrictions ease, we haven't seen that happen suddenly, Courage.
Yes, and again, let's blame COVID for some of these things. But then again, if you notice the jump we saw for May, it is a slower increase compared to the kind of increase we saw in April. because the April increase was 2.8% from 7.8 to 10.6. But the May increase was from 10.6 to 11.3, which is 0.7%. Now, it means that as the effect of the panic buying prior to the lockdown continues to die out of the system, we will see increases, again, because supply side disruptions persist, because of the fact that we are not yet in the harvest season. Right. Inflation will still go up for a couple more months, but at a slower rate before we start to head down when the harvest season comes through. So we should expect it to go up 1 or 2 more months, but at a slower rate, telling you that the pressures will be decaying over time.
And as we blame COVID and seeing that it's going to stay with us for quite a while, when do we expect things to normalize?
Well, if you look at the forecast that is being put out by, say, the World Bank, the IMF, and other agencies, a lot depends on how quickly COVID fades away, and to the extent that the expected recovery in 2021 is based on the assumptions that COVID fades away in the second half of this year. But then again, you want to be very cautious, because right now in the US, there are talks of a second wave or spikes in the virus infection rate. And then we also are experiencing our steep increases as far as the daily reportings are concerned. So it gives you reason to be cautious that even in the second half of this year, we might not see that fading away of COVID. Then a lot will then depend on how quickly we get a vaccine for this. So for me, I think we would have to deal with some of these things into latter part of 2020 or early 2021 by maybe mid-2021 for us to see things, improving when vaccine and other measures start to yield results.
All right, we'll keep being hopeful. Thank you very much indeed, Courage Mate. He is an economist with Data Bank.